Hey, hi everyone. Welcome back. In this video, we are going to look at the investment thesis of a listed Indian automotive company. Is none other than Force Motors. You must be noticing this new vehicle on the roads these days, which is called Urbania, which is like a recently launched product by Force Motors in the light commercial vehicle segment. It's a very niche category in India, but it's growing rapidly. And yeah, this product has been receiving a very good response in Indian markets. And also, you must be aware of all the other different products of this company. You must be knowing the Force Tempo Traveler, which is widely used in school buses, government vehicles as ambulances, or office fleet networks, right? So, this is one such another popular product from this company. And then also, you should be knowing about these vehicles which are being supplied to Indian Army, which is Force Gurkha and also Force Tracks. The company is known for its strong build quality, and the company is also having a engine manufacturing division, which it supplies to various other original equipment manufacturers, which you will be looking further. So this company's share price has rallied a whopping 82% in the last 12 months, which is like a solid beat over our benchmark Nifty index. So what's the reason for this outperformance, right? So in this video, we're going to look at that exactly what are the factors which drove the significant share price outperformance. And we're also be gonna looking at whether this rallies can be sustainable in the future. And is it like a good investment opportunity, right? We're gonna look at that thesis as well. So before jumping into that, this is going to be a short framework of how we look at analyzing listed businesses. It's a framework called GQV investment framework, which nothing stands for. G for growth, Q for quality, and V for valuation. So basically, to give you a brief idea about it, so growth stands for earnings and sales growth of the business. Whether are there any good growth outlook for the business in the future in terms of its top line sales or any margin expansion potential or earnings growth potential in the medium to long term, right? Which would ultimately lead to value creation for any business and also lead to share price performance, right? So that's the first factor that we'll be looking at, which is growth. And secondly, we're going to look at quality, just nothing but financial balance sheet and cash flow quality of the business. We would ideally want to invest in high quality businesses driven by strong competitive modes and good management quality with significant financial strength in their balance sheet. This can be identified through various financial ratios like profitability ratios, return on equity, return on capital employed, or we'll be looking at balance sheet strength, also looking at cash flow generation potential of the company. We'll look at how good the corporate governance of this company is, how the management quality, and etc. So that stands for the quality factor. And finally, that V for valuations. So even though the company has like really good growth potential and it's very strong quality balance sheet, whether is it rightly priced? Are we buying the company at the right price? So that's why we want to pay a lot of attention to valuation because all these high growth and high quality company are typically traded at triple digit P valuations because entire valuations in the mid cap and small cap space has been heated up over the last few quarters. So we want to avoid all those highly valued companies, and we're going to look at good companies with reasonable valuation, right? And also we would want to avoid value traps, which can be typically due to weak growth prospects or lower quality businesses, right? So this is typically a short framework. So let's jump into our company analysis, which is Force Motors. So to give you a quick brief, the company is into development and manufacturing of automotive components and vehicles. So the range of products include light commercial vehicles, which is called LCVs, and multi-utility vehicles, which is called MUVs, and small commercial vehicles, which is SCVs. And they also have special vehicles and agriculture tractors. The tractor segments have been recently discontinued by the company. They also have a subsidiary, Tempo Finance, which is engaged in providing financial services through its joint venture company, Force MTU Power Systems. And the company currently has 70% market share in the light commercial vehicle business. And as you already saw in the first slide, the company has recently launched new products. Firstly, the Urbania, which is like a sleek premium traveler range with 33 and 41 seater monobuses. And they also launched a new platform called Gurkha. So to look at the revenue split of the company, so 48% of the business is coming through manufacturing of commercial vehicles, which is LCVs, MUVs, and small commercial vehicles, which we saw. And 36% comes through motor vehicle engines, which they supply for other third-party clients. And the other comes through parts and accessories, which is the remaining 7 and 10%, right? So it's like the brief bifurcation of the revenue for the company. So here's a bit deep dive on the company's leading position in the LCV passenger segment. So as we already said, this company operates in the Indian automotive industry in a very niche space, which is like passenger segment of light commercial vehicles. So as an investor, we want to look at and invest in companies which have a virtual monopoly in the industries where they operate. Here, if you look at Force Motors, where it's operating in passenger segment of LCV, which is basically the school bus and ambulance segment, the company has a solid leading market share of 70 to 75%, right? So that's a really good plus for the company. And the company recent product launch, which is the Urbania, is in like the premium light commercial vehicle segment. And the other brands we saw, which is like Tempo Traveler in private vehicles, school buses, and ambulance segment. And they also have a segment called Tracks in the utility vehicles, and also Gurkha and Cityline in the UV segment. So in the second segment, which we saw, the engine motor vehicle engines assembling division, right? So this company does it on behalf of two major clients, which is BMW India and Mercedes-Benz India Private Limited. So the company assembles engines for these two companies through its automotive component plants, which is located in Chennai and Chakan, respectively. They also have a joint venture, which is Force MTU Power Systems, with none other than Rolls-Royce Solutions. The Force Motors owns the majority stake of 51% in this joint venture. So this is basically to produce engines for power gen and railway applications for a leading luxury private vehicle company. So this, you're looking at the revenue breakup, 56% from LCV and utility vehicles manufacturing, 28% from engine assembly for BMW and Mercedes-Benz India, and others, which is like parts supply and other segments, which contributes to 16%, right? So this is like a breakup of the company's total business. And in the bottom, you can looking at the key suppliers and customers for the company, right? So let's jump into the financial analysis of Force Motors Limited. So here you are looking at a snippet from the recent credit rating report from CRISIL, where they have upgraded the long-term credit rating to CRISIL AA plus, which is a stable rating for the company. So let's briefly look at the rationale for this assessment. So this upgrade mainly is reflected in the sharp increase in the overall sales volume of the company, which grew by around 25%, mainly driven by growth in the small commercial vehicle segment and the light commercial vehicle segment. in the last fiscal year. So we saw a lot of premium products being introduced in the product line, right? Which is like the Urbania, tracks, etc. So this premiumization has led to a better product mix, which drove the company's realizations, along with a steady growth in the automatic component business. It led to a healthy revenue growth of 38% in the last fiscal year, year on year. So besides that, this also ultimately led to operating margin expansion to around 13.5% operating profit margin in fiscal year 2024 compared to 7.5% in the previous fiscal year 2023. So that's a really sharp jump in the operating margins for this company, mainly supported by the operating leverage gains and improved product mix, which we saw. Um, this is about the growth factor of the company, which we started talking in our investment framework, right? So this company is showing strong signs of growth, both in terms of overall top line sales, their operating margins, right? Now, looking at the balance sheet quality, the gearing ratio improved to 0.23 times as on March 2024. Gearing is basically the debt to equity. The company has 0.23 times of overall debt compared to its total outstanding equity. And their interest coverage ratio remained very healthy at 15 times in fiscal year 2024, which is also a very healthy sign. The company is also undertaking a lot of capital expansion plans. They've incurred a capex of 208 crore in fiscal year 2024 and also has planned a capex of around 600 to 700 crore per annum over the medium term. So this capex is expected to be funded largely through internal accruals, which would ultimately keep these debt protection metrics healthy. So we expect this interest coverage ratio of 15 times to be improved over 20 times in the near to medium term. So here you can see the growth aspects captured through the income statement of the company. It's an annual income statement over the last decade. Here you can see some really clear trends which is happening in the company. A really good turnaround in terms of operations. So if you focus on the highlighted parts in the income statement, in March 2020, right, during the lockdown, where all the schools, offices, and all the government operations shut down, right? So the company has incurred a lot of slowdown in its overall sales, and the company also started to incur losses in fiscal year 2021, around 124 crores of loss. And you can see a good turnaround happening in the company's income statement, right? So the drop in sales is being turned around from fiscal year 2022, 2023, solid high double-digit growth from 2022, fiscal year 23, and around 39% year-on-year growth in 2024. And if you look at the operating profit, right, here in this place where I'm highlighting the cursor, right? So the operating profit is also showing really good signs of improvement from 8% in fiscal year 2020, dropping to around very thin 1%, right, in 2021 due to the COVID pandemic, right? And it's you can see a very smooth increase from 1 to 2%, 2 to 6%, 6 to 13, and it's being stabilized right around 13% operating margin, which is like a really good sign of operating leverage that has been acting in the company due to the improvement and premiumization in its product mix, right, which we saw with new product launches. So the company is able to improve its operating margins with careful execution. And also you can see the turnaround in its profits ultimately, right? And in the bottom, you can look at the long-term compounded growth ratios for sales and profit. So historically, the company has displayed around 52% compounded sales growth in the last 3 years, whereas 80% compounded profit growth in the last 3 years. And the stock price has also reflected the same. The stock price had rallied around 74% annually, right? This is not like total number, it's like an annual compounded growth the last 3 years. And important metric for profitability, which is return on equity, right? The company's return on equity has jumped to around 19% in the last trading 12 months, right? So, which is like a really good sign of improving growth and profitability metrics in the company. Here, the same is reflected in a quarterly time frame. You can see a smooth increase in the sales of the company. The bars typically represent the quarterly sales numbers, whereas the three lines in colors red, yellow, and green typically reflects the margins. So I wanted to highlight the key cost which the company incurs is material cost, which goes about production of the commercial vehicle and assembly of engines, right? So around 81% of overall cost is for material cost. So I just wanted to highlight that. So so that cost is being reflected in the company's margins as well. The latest gross profit number margins of the company was around 26%. Operating profit is somewhere around 14 to 15%, and the net profit margin is like around 7%, which is like a solid improving trend. Correct. Now moving on to the quality factor in our investment analysis framework. As we all already discussed, right? The company's interest coverage ratio um, is basically at 15 times in the last fiscal year 2024, which was historically around at 5 times in last fiscal year. So 3 times improvement in their interest coverage. And the gearing stood at like very low at 0.25 times in the last fiscal. So they are very comfortable in their leverage position. And they also have a healthy cash generation business. And their funding of capex, the expected capex is around 2000 crore between fiscal year 2025 to 2027, around 800 crores annually. And this capex, as we already discussed, is going to be funded by internal accruals from their strong operating cash flow generation. It will keep their leverage in check, right? The company is intending to be debt free by the end of current fiscal year. So, in the quality factor, we also discuss about looking at the management of the company. So, we have a strong promoter group. The holding company is none other than Habe Firodia Group, which owns 57.38% stake in the company, Force Motors Limited. And the company is also having significant market value in Bajaj Group of companies. Now, let's if you look at the market investments of this parent company, they have around 31,000 crores of investments in Bajaj Group. So it's important to understand who are the promoter group, right? Who's Habe Firodia Group. So a brief analysis at the Forbes, we had a look who Mr. Habe Firodia is. It's none other than the chairman of Force Motors. So basically, he used to be part of the Bajaj Auto Group, uh, but due to a feud between the family, the company fell out from Bajaj family in 1968, and currently he is running as the chairman of Force Motors, and his son, Mr. Prasanna Firodia, is the managing director of Force Motors. Together, they are running this company into a strong future direction. So the net worth of Habib Firodia is like around 4.4 billion USD, which makes him in like the top billionaire list in India. So yeah, strong promoter group. Now moving on to the valuation aspect, right? Let's look at the company Force Motors with respect to their competition. So here you're looking at Force Motors in line with Tata Motors, Ashok Leyland, Electra, Isuzu. So the above companies are also into passenger and commercial vehicle segment. If you look at Force Motors, it's currently commanding around 8,800 crore of total market cap with a P of around 18 times, which is very low, which is lower than the benchmark Nifty's P, right? And also the market price to free cash flow ratio is around 34 times, which is also reasonably undervalued. The company is commanding a return on capital employed of 23 percentage, which is like a really good number. And here you can see some growth numbers. Last 3 years compounded sales and earnings growth rate of 52 and 80% respectively. Very low debt in their balance sheet, which makes the balance sheet strong. And price to earnings growth metric, which is also another important metric to look at, which is like around zero point 0.8. Anything less than 1.5 or 1 is really good. So the company is down from its all-time high price by around 34%. So it's in a good consolidation, right? So looks like a good time to add on to the stock. So yeah, that's about a short, brief peer comparison in terms of financial numbers. And if you look at some ratios, the cash conversion cycle is improving. It's lowering from the highs of 31 days to around 27 days. And the return of capital employed, the profitability of the company has also improved from around 10% to 24% in the last fiscal, which are all healthy signs for a good run company. Now, looking at the valuation piece, right? So we already saw the price to earnings of this company is around 18 times, trailing 12-month PE, 18 times, uh, which is lower than the historical median of the company, right? So here in the first chart, you see, right, the dotted line that represents the historical median PE value of the company, which is like around 24 times, whereas currently the PE is at 18.5 time, which is like really undervalued right now. So it's undervalued compared to its own historical median, as well as undervalued with respect to its own peer group, right? Um so this comes at a really good growth potential. So you can see the bar chart, which is nothing but trailing 12-month earnings per share. So with strong earnings growth, the P ratio has actually derated instead of re-rating, right? So we can see a really good re-rating potential in the valuation aspect for this company. The same thing is being reflected in the EV by EBITDA multiples as well. So the current EV by EBITDA multiple is hovering around 8.5 times, whereas the historical median, the dotted line which you see, has been around 12 times. So both in terms of price to earnings and EV by EBITDA, the company is looking very undervalued, lower than one standard deviation from its historical 5-year median number. So yeah, we also saw the share price has also, even though it had rallied around 84% in the last 12 months, it has significantly corrected by around 34% from its all-time high. Looking like a good time to add your stakes. Now it's also important to look at some of the investment risks or weaknesses of this company. So the company has recently exited the tractor segment in fiscal year 2024 as it was unable to ramp up and continue to remain a minor player in a highly competitive tractor market, which shows the weakness of execution but also they did a really quick decision of exiting instead of letting their losses deepen, right? That's one aspect to look. And second is the company, since it's operating in a very niche segment in the Indian automobile industry. So this industry is typically subject to a lot of macroeconomic headwinds like inflationary pressure, economic slowdown. So when I mean economic slowdown, since it's a very discretionary item, right? So when the economy is going through a downturn, the consumer will not spend or postpone their spending in purchase of discretionary items, right? So, so the company is typically exposed to all these macro factors. And despite this intense competition in the market, the company is like a market leader with around 75% market share in the light commercial vehicle segment. So this headwinds uh, does not mean to impact this company in a very intense way, but it's a point to be noted. And as we also discussed in the income statement analysis, in the margin analysis of the company, so the company's major expense item is the raw materials and component prices, which constitutes around more than 50% of the total revenue. So this raw material is tend to be fluctuating in the market and is heavily influenced by the international commodity prices. And this trend has always been cyclical, mainly due to the demand supply situation. So that's something also to be noted, which shows the cyclicality in their margins, right? And the company has been reporting really good volumes and improvement in their product mix, which led to improvement in their operating margins despite all these fluctuations. So, yes, moving on to double click on that particular news of shutting down their tractor segment. Um, so, this tractor segment typically accounted around less than 4% of the company's total revenue. This is part of the company's product rationalization program, and it will focus on the company will shift their focus only to their core segment, which is like the shared mobility, last mile mobility, and creation of special vehicles for civil and defense application, right? Um, so we also saw that 36% revenues come from contract engine manufacturing, uh, which the company is supplying the engine assembly to BMW and Mercedes, right? So the company wants to focus on that as well as the production of their commercial vehicles. So it's a good rationalization plan and good move of cutting down their loss leaders. Well, this is a important slide. So the company has planned to develop 100% electric variants for its four platforms. Which is intensive operations, which is the traveler product line, which is mainly used for school buses and staff buses, ambulances, etc. And the second platform is extreme GVW operations, which is city bus, staff monobus, school monobus, and the normal operations and multi-utility operations, which is tracks cargo, passenger, and recreation. So the idea here is the company is in full-fledged move to launch a lot of EV products in the upcoming quarters and fiscal years. So this is like a really good time to look at the stock since we saw that the valuation is currently trading at 18 times price to earnings, right? And if you are someone who's actively tracking the markets, you must be knowing the kind of multiples all this electric vehicle exposed sectors are being traded, mostly in high double digit or even triple digit in some cases, right? So EV is like a very growing theme, and all the companies which are exposed to this EV theme is like really, really expensively valued in the market, whereas this company is in a very nascent stage of about to be launching a lot of electric vehicles. So yeah, really good very interesting aspect to note and keep a track of um, in the upcoming periods. So this is like a snippet from Economic Times news article of Force Motors starting their overseas expansion plan. So if you look at this report, so during the COVID time, where we discussed, right, the company's capacity utilization dropped by around 50 percentage to levels of even 35 percentage, right, as low as 35 percentage. So during this painful period, the company had engaged to a consulting firm, Ernst& and Young, for their cost optimization plans. So due to this consultation initiative, it led to the closure of 30-year-old agriculture tractor business and the cost rationalization strategy, right? They want to focus on their key core businesses. The founder, Ferodia, has said that he's intending in creating, I would say, best-in-class shared mobility passenger transport solutions, whether it is traveler platform, the monobus platform, or the utility vehicle platform. So he just want to just focus on these segments, right? So these are some of the future transportation themes globally, and the companies is also not walking the talk. They have invested around 1,500 crores to develop these products in order to play in its strengths, right? And coming to its internationalization strategy, right? So the company is trying to push its products in global markets, starting with Kenya for its traveler plans, because they want to tap on Africa opportunities, correct? So he says we are looking at definitely one more assembly location there. From a tax point of view, everything makes a lot of sense for them. This is about the future opportunities for this company. One is the EV play, second is internationalization, and the cost rationalization the company has done. All these are like key strategic drivers for the company's future growth potential. And I want to end the presentation with this snippet. The company is also a really good play on the India's defense play. The company supplies a lot of its product line to Indian Army. You can look at the images of the tracks segment, the light strike vehicle, LSV, light strike vehicle segment, which is being supplied to Indian Army. And on the right, you can see the Tempo Traveler line being used as Uber shuttle. So you're looking at this photo. So Prasan Firodia, the managing director, has posted this on his LinkedIn, where he's delighted to have Dara Khosrow Shahi. He's the CEO of Uber globally. So they are planning to use the Uber Force Traveler for the Uber shuttle in their US offices, right? So you can see a lot of action taking place in the company. Um, so I want to end this presentation here. So to sum up, we looked at key three components of looking at this business. One is growth, the fundamental quality, and we also look at the valuation. It's also, we took a lot of time to understand the key product line of the company. Um and yeah, so I'll end this presentation on this good note that it's a really growth company, a quality company available at a very reasonable valuation. So it's a really good case study and an investment opportunity to look at. So yeah, so I'm giving the community link of our channel in this description. You can use that link and to join our community to get access to key updates on different interesting investment theses like this in the future. So until then, stay curious and stay invested. Thank you.